Hello everyone and welcome back to our channel. My name is Mayank Ajmani and the topic for our today's discussion is investing in mutual funds. So to begin with, let's first understand what exactly is a mutual fund. So a mutual fund is a type of financial vehicle which is made up of a pool of money collected from many investors like you and me to invest in securities like stocks, bonds, money market instruments and other kinds of assets. But how does a mutual fund work? So a mutual fund works by collecting money from different investors like you and me, and this money then is allocated to an asset management company where a investment banker or a manager invests this in different kinds of assets so as to give a return to us which is higher and which is a good level of earning. So what are the different kinds of mutual funds? So first is the equity funds. So this is the largest category of funds, which is equity funds. So as the name implies, this sort of funds invest principally in stocks. Some equity funds are named for the size of the companies they invest in, like small, mid cap, or large cap. The other is fixed income fund. So a fixed income mutual fund focuses on investment that pays a set rate of return, such as government bonds, corporate bonds, or other debt instruments. Moving on is the balanced funds. So a balanced funds invest in a hybrid of asset classes, whether stocks, bonds, money market instruments, or alternative investments. The objective of this kind of fund is to reduce the risk of exposure across asset class. This type of fund is also known as an asset allocation fund. So there are two major variations of such funds designed to cater to the investor's objective. The next is the market fund or the money market funds. So a money market funds consist of safe, that is risk free, short term debt instruments which are mostly government treasury bills. So this is considered to be a safe place to park your money. You won't get substantial returns, but it's definitely that you won't have to worry about losing your principal. A typical return is a little more than the amount you earn in regular checking or savings account and a little less than the average of certificate of deposits. The next is funds, or it's also called income funds. So, as the name suggests, they are for the purpose of income, that is, to provide current income on a steady basis. These funds invest primarily in government and high quality corporate debt holdings, these bonds until maturity in order to provide interest streams. While fund holdings may appreciate in value, the primary objective of these funds is to provide steady cash flow to investors. The other is the international or global fund. So this fund invests only in assets located outside your home country. Global funds means that you can invest anywhere around the world, including within your home country. It's though tough to classify these funds as either risky or safer than domestic investments, but they have intended to be more volatile and have unique country and political risk. The other is the specialty fund. So, this classification of mutual funds is more of an all encompassing category that consists of funds that have proved to be popular but don't necessarily belong to more rigid categories as we have described above. The last one is the exchange traded fund. So it's kind of a twist on the mutual fund, which is called exchange traded fund. These ever more popular vehicle pool investments and employ strategies consistent with mutual funds, but they are structured as investment trust that are traded on stock exchanges, and they have the added benefit of the features of stocks. So, for example, ETFs can be bought and sold at any point through the trading day. ETF can also be sold short or purchased on margin. So the next is the benefits of mutual fund. Mutual funds bring many benefits along with it. So the first one and the most basic one is diversification. So diversification or the mixing of investments and assets within a portfolio to reduce the risk is one of the most basic advantage of investing in mutual funds. Experts advocate diversification as a way of enhancing a portfolio's return while reducing its risk. The second is the economies of scale. Mutual funds also provide economies of scale. Buying one spares the investors of the numerous commission charges needed to create a diversified portfolio. Moreover, small investors or retail investors, as we call, like you and me, we don't have much knowledge of the investing, and there's always a risk of investing in some bad stock. So, this helps in diversifying our portfolio. The next is the easy access. Trading on the major stock exchanges, mutual funds can be bought and sold with relative ease, which makes them highly liquid investment. Also, when it comes to certain types of assets like foreign equity or exotic commodities, mutual funds are often the most feasible way. In fact, sometimes the only way for individual investors to participate in such transactions. The other one and the most important one is the professional management. This is the primary advantage of mutual fund, that we as an investor don't have to pick stocks and manage investments on a regular basis. Instead, a professional investment manager takes care of all of this using careful research and skillful trading. So, how to start investing? This is the question which many of us have after knowing what exactly is it. So, there are three basic steps. First, we need to identify investment objectives. What are our investment objectives? To earn steady income or to have high returns or capital returns in short time. Also, we need to determine the time horizon, whether we want to invest for a short period or a medium period or for a long term period. And the third and the final step is we need to choose a mutual fund investment. There are numerous mutual funds with its features and its portfolio. We need to look precisely at the portfolio of each mutual fund and then choose the mutual fund that best suits our investment needs. Finally, this is a very famous wording of Warren Buffett, which says that successful investing takes time, discipline, and patience. And this is the mantra of investing in mutual funds, or to say it, investing in stock markets. Thank you. Also, if you like our video, do subscribe to our channel and press the bell icon for regular updates.